Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on April 25th, 2022. Quick reminder, trading tomorrow at 11. Trades and results from last week, as we always do. I really want to spend some time trying to help you parse, whatever the fancy word is, in your own mind, the difference between volatility and risk. And I want to do this through a trade we concluded successfully in the trade desk. But first, last week, we closed a couple of winners, and one of them was the trade desk, the other was Skechers. It shows the value of selling something a little bit more in advance. Trade desk was originally to be an 11-day trade. We closed it 3 or 4 days early. And you can see that we had very, very nice rates of return, 0.7% for trade desk, 1.3% for Skechers. And this is something you will see more and more and more of, is the placing of trades a little bit further out to capture big chunks of premium due to volatility, but giving us the time-based flexibility to close positions early within target annualized rates of return. For example, trade desk, you'll see we closed with a 33% annualized rate of return. Now, we had a lot of cash coming in last week for both good and bad reasons. Good reasons for me is I want to see cash coming in. That's what we're all about here. Some of you, and I can tell by emails, are beginning to get beyond nervous. Some of you are margined, which I never take into account, and you're not able to accept shares and so forth and so on. But the focus here is we usually start with puts. We may end up selling shares. We are down on several positions. The S&P was down almost 120 points on Friday, and I want to talk about that in a minute. But the bottom line is the rates of return are very high. The cash keeps pouring in, and if you can find the way to completely agree with me, is that over the course of 3 months, 6 months, a year, the amount of cash that we're generating, which now is considerably higher than, let's say, it would have been 3 years ago. And my targeted cash is higher than it was 3 years ago. We'll outperform the market. It's just a matter of simple second-grade arithmetic. And you can see the goal was very, very, very high. We did sell some long-dated positions, but we collected enormous amounts of cash while rolling, which may not be satisfying. It's not a fresh trade. It's not a new trade. It's not sexy. It's money in the bank. And you can see where we're at. We had a really, we sold long-dated position on Zimmer Logistics. And the bottom line is big chunk of cash coming in, which to my mind should help in part offset concerns about what happened towards the end of the week. So, we were up 1.5%, then we're down 1%, and then there was the big sell-off at 2.8%. Before I speak to volatility versus risk, there was a very important tell, like if you were at a poker table, about the sell-off on Friday. The sell-off on Friday is interest rate driven and people not wanting to hold into the weekend, but interest rate driven, which on a rational basis makes no sense. Meaning it's as if some percentage of the market, of traders and investors who can drive the market, are not listening. They're either deaf or tone deaf when it comes to what the Fed has been saying. So Powell reinforced the need for interest rate hikes. He reinforced, as Bullard had said, another Fed governor, a few days before, there might be a 0.5% increase. What are these people reading? Are they reading Marvel Comics and not reading the New York Times business section or the Financial Times? Anybody with a 4th grade education, and I'm being not being a lot negative here, would understand what Powell said was not a surprise, but the market was very surprised. And one of the things that's become very obvious is that as soon as some sentiment takes place concerning, oh, he really is going to do this, or interest rates are really going to do this, bonds get hit reflexively. Sometimes people have algorithmic trading off a headline. Not that much. It's more complicated than it seems. And then the trade hits equities, and we have what happened, and it's automatic. Someone hits a button or has someone already programmed saying if interest rates are going to go from 3.5 to 3.55%, it's going to move 5 basis points, then you have to liquidate 1/4% of the portfolio based on either your highest gainers or your lowest gainers or whatever. So a lot of this is algorithmic and is still tied to false assumptions about where interest rates are going. And we now need to trade based on that. Getting back to that, interest rate confusion, creates volatility. But interest rates going up a tenth of a point does not impact the number of people buying iPhones. Regardless of people screaming on CNBC about how this is going to hit the consumer, I think they're screaming because they like the coffee in the waiting room at CNBC. The issue is what this really does is turn us into stock pickers, and that we cannot guess how smart or how stupid the market, well, ignorant or smart the market is. The market is not stupid. It may be ignorant, but not stupid. And the market, of course, sets the price. But volatility is found in short-term movements in stocks, not in the performance of companies in the real world, which may be little, if any, solace when you're looking at flashing red on your screens. But if you focus on cash and the kind of discipline showed in the trade desk trade, which I'll go through in a moment, you'll see how we can not only ride this out, but when even if this becomes a full-blown bear, we will end up being way, way, way ahead of the market. And I'm not saying that to calm you down. What I want to say to calm you down is this: volatility is not risk. Volatility impacts us in different ways. It should encourage us to sell options as premiums go up. It discourages people because it makes them feel very tenuous in the relationship to the market. It gives long-term investors who are trading an edge over the market, and it could give short-term traders who are looking at their portfolio every day and every Friday a nervous breakdown. And I'm there with you. I trade high beta stocks, and my personal portfolio, is blinking red. And because I have done this and been through this so many times now, the reason that I can say this with some calm is I go back to what really is volatility and what really is risk. Is volatility a loss? It's the movement of a stock, or let's go back to the previous slide. Is it a friend or a foe? We need to turn it into a friend. And volatility may impact or does impact the options you sell, but certainly it doesn't impact your bullpen. A bullpen's rooted in the real world. You could have 25 bullpen stocks. You could be trading all 25, and they all could be down, which 20 or 25 wouldn't surprise me. But the bottom line is, if they're throwing off 1% a week or 0.8% a week, you've picked the right bullpen. And option selling opportunities are great when stocks get hit. Now, I get questions: is it time to buy calls? And the answer is no. Buy shares and sell calls, and we have enough open positions with calls. But this is still a very good time to sell puts. Now, why do people confuse volatility and risk? It's easy to do. I used to. But the real thing that I can give to you, and this is the heart of, we used to be an independent program, this six-figure portfolio coaching program, which we're thinking of introducing again as an independent program. It's now a core training program in the master's program. Is we do a boot camp, and one whole survey, a self-assessment survey, is on risk. How do you assess risk? What do you think about risk, and so forth and so on. The hard part of managing risk is it has a tendency to obscure your long-term goals. I want to do 20% a year. My portfolio is down 14% with the market. If I do 20% this year, and this year with volatility ways you should do more, I'm going to be ahead of the market. Well, that's easier said than done for many people. And if you focus on the trade expiring on a Friday rather than the company and where the company might be and the stock 3, 6, 9, 12 months from now, you're not only torturing yourself, you're going to mismanage positions. And please remember, this is not a trading service. I am not a trader. You should not be a trader looking at, oh, what am I going to do by Friday? We do positions, and positions are more often than not multiple trades. So speaking of a very short-term position, to highlight the difference between volatility and risk, I want to walk through something many of you did and hopefully made money on. This is the trade desk. Very volatile stock. Very. But it is a stable and rapidly growing, I should have put the word rapidly in there, market-leading company. It supplies services, artificial intelligence services, servers, software, support. You're an advertiser, you want to advertise XYZ or a widget or whatever. How do I get to someone's phone? How do I get to someone's iPad? How do I get an ad on Hulu? How do I get an ad on Paramount Plus? And if Netflix introduces a streaming, an ad-supported service, so forth and so on. How do I get my ads in there? And this is what they do by far better than other people. And we've chosen to rent it for now because of its volatility. And what I mean by rent, we're selling puts. We're not owning shares. And one of the reasons is with puts, you can sell puts really way out of the money. As you know, I call this a silly put because it's more than 10% out of the money. I did a presentation on that in our updates a few weeks ago. But let's take a look. It was at 67.43. We sold at 59. So it was way, way, way out of the money. And we generated, this is the alert, a potential return of 38%, an absolute return of 1.2%. So what did this really mean for you if you're making your decisions? 12.5% out of the money. The charts, the 20 and the 90, showed significant support around 60. Now, support doesn't mean it never goes below 60, but it means it rotates back to 60 for a day or two. It goes down to 58.50 or what have you. The chains, more importantly, actually showed if the stock fell to that strike price, at the strike price lower, we could easily roll it, which is a precondition for putting any, for me, for putting any trade on. And the longer term expiration, a little bit longer given market conditions, I did get an email. Why do you want to put something out there not 4 days but 11? The flip side is it gives you a lot of flexibility the way the stock is moving. You have a lot of cash in hand. You get to manage it with greater flexibility. So we did close. We closed it early, and we had a very tidy profit. It was 0.7% in 8 days, or 33% on an annualized basis. This is above even the threshold of I will not consider putting a new trade on unless it's 32%. I wouldn't think of closing one unless it's 25, although in this market I might close it sooner. And the hope is that 20% of all trades, we get a 20% return total from all our trades. So you can trade this market. We got ahead of the sell-off on Friday. That the stock actually closed right at 59 on Friday. We probably could have, but we couldn't have held on because the way that this stock trades and how volatile it is, not the company, the stock, you might have had to wait till 1 minute to 4 to close the trade at a price better than the 25 cents we paid. So going forward, please, whatever you do not confuse volatility and risk. If you are in the Income Masters program and you haven't taken the boot camp, shame on you. Please go through it. Volatility, I'm not going to, even for me, it's emotionally draining. These markets, the ups and downs of the markets, if someone would tell me the market's going to go down 20%, but it's going to go down 1.5% to 2% a week for 10 weeks, we could make so much money, we could all retire on a desert island because of predictability. There is no predictability in markets, right? Someone will ask a question, do you think this is going to do this? And the answer is, if I 100% knew, we all wouldn't be here. But volatility can lead to mistakes when it impacts you that well. But it does give you more flexibility and lets you alter tactics to capture the premium that's out there. And this gives us the ability. You would not trade a trade desk if the premium was half that, because you still need that 12% out of the money to trade it comfortably. So the premium also has to be there with the volatility. This is Michael Schulman. Thanks for listening.